Have you ever opened your investment account, stared at the number on the screen, and quietly wondered if you're actually getting anywhere? Not just moving, but truly progressing toward something meaningful, toward real financial freedom. Maybe you've managed to save a few $1,000s. Maybe you've been consistent for years and finally crossed $20,000 or even $30,000. On paper, that's progress. It's discipline. It's effort. But emotionally, it often doesn't feel that way. Because no matter how far you've come, the idea of reaching $1 million still feels distant, almost unreal, like a goal reserved for someone else. Someone with a higher income, better opportunities, or more financial knowledge. And that feeling creates a dangerous question in your mind. At this pace, will I ever actually get there? This is where most people begin to lose motivation, not because they lack discipline, but because they misunderstand how progress really works. We're taught implicitly or explicitly to think about money in a straight line, a simple, logical path. Save $10,000, right arrow, you're $10,000 closer. Save $50,000, right arrow, you're halfway to $100,000. Save $100,000, right arrow, you're 10% of the way to $1 million. It feels intuitive, clean, predictable. But here's the uncomfortable truth. Wealth doesn't grow in a straight line. It never has. And this misunderstanding is exactly why so many people give up too early. They measure their progress using the wrong model, conclude that it's too slow, and walk away right before things were about to change. Because in reality, the early stage of building wealth is supposed to feel slow. It's supposed to feel like effort outweighs results. That's not a flaw in the system. It is the system. What most people don't realize is that they are judging an exponential process using linear expectations. And when you do that, progress will always look disappointing, even when you're exactly where you need to be. So the real problem isn't your income. It isn't your strategy. It isn't even your discipline. It's your frame of reference. And once that frame shifts, everything else starts to make a lot more sense. If financial progress isn't linear, then what is it? The answer is both simple and powerful. It is exponential, driven by a force known as compound interest. At its core, compound interest means that your money doesn't just earn returns, it earns returns on its returns. In other words, your capital begins to reproduce itself, and then those reproductions begin to reproduce as well. This creates a structure where growth is no longer additive, but multiplicative. And once multiplication enters the equation, everything changes. In the beginning, the effect of compounding feels almost invisible. Your own contributions dominate the growth. You work, you save, you invest, and the account slowly climbs because of your effort. It feels linear, predictable, even slightly discouraging. But underneath that surface, something important is happening. Your money is learning how to work. And at first it works quietly, almost insignificantly. A few dollars here, a few hundred there, nothing that feels life-changing. But compounding is patient. It does not rush. It does not demand attention. It simply builds momentum in the background. And momentum, once established, becomes self-reinforcing. The key misunderstanding most people have is assuming that this process remains constant. They expect the same level of effort to produce the same level of return forever. But compound growth doesn't behave that way. Instead, it follows a curve. Slow at first, then gradually accelerating, and eventually becoming explosive. The early phase feels like you are doing all the work, and that is true. But what is not visible yet is that you are also building a system that will eventually outgrow your input. At some point, your returns will no longer feel like extra money. They will start to feel like another source of income entirely, one that does not depend on your time or energy. And that is the first real shift from earning money to building wealth. Because wealth is not defined by how much you save. It is defined by how much your money can generate without you actively working for it. And compound interest is the mechanism that makes that transition possible. To understand why $100,000 is such a powerful milestone, you first have to understand what it takes to get there. Imagine you commit to investing $100 every week, about $400 per month. It's not an extreme number, but it still requires consistency and discipline. It means saying no to some small comforts and redirecting that money towards something you won't immediately see or feel. Now assume your investments earn an average annual return of around 8%. This is not an aggressive assumption. It is actually slightly conservative compared to historical market performance. At first, the results feel underwhelming. Year after year, your balance grows, but not in a way that feels transformative. You check your account and see progress, but not the kind that changes your lifestyle. It feels slow, almost frustrating. And yet, after roughly 12 years, something important happens. You cross the $100,000 mark. But here's what most people don't realize. That $100,000 is not purely the result of market growth. In fact, a large portion of it comes directly from your own contributions. Over that period, you may have invested around $60,000.65 of your own money, while the remaining $35,000.40 comes from investment returns. In other words, during this stage, you are still doing most of the heavy lifting. Your money is working, but it is still learning. It hasn't reached full efficiency yet. This is why the first stage feels so mentally difficult. Not because it is mathematically inefficient, but because psychologically, it does not feel rewarding enough for the effort involved. You are putting in consistent work, but the results don't yet reflect the scale of your ambition. And this is where many people stop. They look at the balance, compare it to their expectations, and conclude that the system is too slow. Some even believe that investing doesn't really work for them. But what they are actually experiencing is the setup phase of exponential growth. Because the first $100,000 is not just about money accumulation. It is about building the conditions for compounding to finally become powerful. It is the stage where discipline is formed, habits are stabilized, consistency is proven, and most importantly, it is where your financial system is quietly transitioning from manual effort to automated growth. You don't feel the acceleration yet, but it is already being prepared. Because once this foundation is strong enough, something very different begins to happen. Once you cross the $100,000 mark, something subtle but extremely important begins to change in your financial journey. At first, it doesn't feel dramatic. You are still investing the same amount each week. You are still waiting patiently. Your lifestyle hasn't changed much, and your daily experience of money still feels familiar. But behind the scenes, the structure of your growth is starting to shift. Up until this point, your contributions were doing most of the work. But now, your investment returns begin to play a noticeably larger role. The system is no longer just supported by your effort. It is increasingly supported by its own momentum. And this is where compounding begins to reveal its real nature. The next milestone, $200,000, does not take another 12 years. It takes significantly less time, often around 6 additional years under the same assumptions. That means something very important is happening. Your money is now growing faster than before, even though your behavior hasn't changed. This is the moment where many people finally realize that wealth building is not linear at all. It is accelerating. At this stage, your account is no longer primarily a reflection of how much you save. It is becoming a reflection of how long your money has been allowed to work. The composition of your wealth also begins to shift in a meaningful way. While you may have contributed roughly $90,000 in total by this point, a growing portion, often approaching or even exceeding half of your gains, now comes from investment returns. This is a psychological turning point as much as a financial one, because for the first time, you begin to feel a separation between the money you actively earn through work and the money that is now generated passively. And that separation changes how you think. You start to notice that your balance increases even on days when you do nothing. Even when you are not actively adding money, the system continues to grow, quietly, consistently, automatically. This is the beginning of financial independence, not in lifestyle, but in mechanism. However, what makes this stage so powerful is not just the growth itself, but the realization that you are now halfway through the journey to becoming a millionaire. Not mathematically halfway in terms of contribution, but functionally halfway in terms of time and compounding effect. And that realization changes your perspective. Because what once looked like a distant, almost unreachable goal begins to feel structurally inevitable, as long as you remain consistent. At this point, the question is no longer, will this work? It becomes, will I stay in long enough for it to work fully? And that is where the real challenge begins. After reaching $200,000, the nature of your wealth changes in a way that is no longer subtle. It becomes increasingly visible in the numbers. This is where compounding begins to shift from something you understand intellectually to something you can actually feel. Up to this point, growth may have felt steady but not extraordinary. You were still mentally anchoring your progress to your own contributions. Even though returns were increasing, your weekly deposits still felt like the real engine behind your account. But now, the balance begins to tell a different story. Each year, your investment returns start to rival, or even exceed, your total annual contributions. This is a critical psychological breakpoint because it signals a reversal of roles. Your money is no longer just supported by you. You are now partially supported by your money. The next doubling from $200,000 to $400,000 happens faster than the previous one, and this pattern continues. Each stage takes less time than the one before it, not because you are working harder, but because the system itself is gaining momentum. Mathematically, this is the nature of exponential growth. Practically, it feels like acceleration without effort. At this stage, something important happens in your perception of time. The years you previously thought of as long begin to feel shorter in financial terms. What once seemed like a decade-long stretch toward a goal now feels like a sequence of predictable milestones. And that shift is powerful. Because once the system reaches this phase, consistency becomes far more important than intensity. You are no longer trying to force growth. You are simply maintaining the conditions that allow compounding to do its work. Over time, the structure becomes increasingly self-sustaining. Even during periods where you are not increasing contributions significantly, your portfolio continues to grow due to accumulated base capital and reinvested returns. This is where many investors experience a psychological transformation. Instead of seeing investing as something they have to do, they begin to see it as something that is working for them in the background. And this shift changes behavior. Spending decisions become more intentional. Long-term thinking becomes natural. Short-term impulses lose influence. Because every dollar is no longer just money, it represents future compounding potential. However, the most important realization in this phase is not the speed of growth, but the inevitability of the outcome, assuming consistency is maintained. The path to $1 million is no longer theoretical. It becomes structurally embedded in the system you've built. At this point, the question is no longer whether compounding works. It is whether you stay aligned with it long enough to let it fully unfold. Once your portfolio reaches around $400,000, the psychology of wealth building changes again, but in a more dramatic way than most people expect. At this point, you are no longer in the building phase in the traditional sense. You are in the acceleration to completion phase, where compounding becomes the dominant force in your entire financial system. What makes this stage different is that your money is now doing most of the work. Earlier in the journey, your contributions were essential. You could clearly see your weekly or monthly deposits shaping your balance. But now, those contributions are no longer the main driver. They still matter, but they are increasingly overshadowed by the growth generated from the existing portfolio. This is the moment where many investors finally realize wealth is not built by income alone. It is built by time multiplied by consistency. From $400,000 onward, the curve steepens significantly. The next doubling to $800,000 happens faster than the previous one, and the final leap to $1 million feels surprisingly short in comparison to everything that came before it. Not because the numbers are small, but because the system is now fully mature. At this stage, compound growth is no longer something you observe yearly. It becomes something you notice quarterly, sometimes even monthly, depending on market conditions. And emotionally, this creates a strange shift. Instead of feeling like you are working toward a goal, you begin to feel like you are simply watching a process unfold that is already in motion. However, what is most surprising for many people is the composition of this wealth. By the time you reach $1 million, you may have only contributed around $180,000 of your own money over decades. The remaining 75–80% comes purely from investment growth. This is the clearest expression of compound interest at scale. Time becomes more powerful than effort. At this point, your portfolio begins generating returns that are no longer trivial. Annual gains alone can exceed what many people earn from full-time employment, and this is where the perception of money fundamentally changes. Because now, your investments produce meaningful income. Your financial security becomes more stable. Your options in life expand significantly. You are no longer just accumulating wealth. You are now living inside the effects of it. And yet, despite how powerful this stage is, it is also the simplest. There are no new strategies required, no complex optimization, no dramatic changes in behavior. Only one thing matters. Do not interrupt the system that has already started working. Because the final stretch to $1 million is not about effort, it is about endurance. And for those who remain consistent long enough, the result becomes less of a surprise and more of an outcome that was quietly inevitable all along. By the time someone understands how the journey from $0 to $1 million actually works, the math is no longer the hardest part. The real challenge becomes psychological. Because in theory, the system is simple. Invest consistently. Earn market-like returns. Give it enough time. Let compounding do its job. But in practice, almost no one follows this path long enough for it to fully unfold. The reason is not intelligence. It is not access to information, and it is not even income level in most cases. It is human psychology under short-term pressure. We live in a world designed around immediacy. Instant payments, instant entertainment, instant credit, instant gratification. In that environment, a 30–40-year financial strategy feels unnatural, almost unrealistic. The idea of waiting decades for results clashes directly with how people are trained to think and behave every day. So what happens? People start strong but slowly begin to disconnect from the process. They look at their account during slow periods and feel disappointed. They compare themselves to unrealistic expectations. They expect constant visible progress, even though compounding does not work that way. And eventually, many of them stop. Not because the system failed, but because they left before the system had time to show its full power. This is where the most important mindset difference appears between those who build wealth and those who do not. Wealth builders do not think in terms of fast or slow. They think in terms of still in the game or not in the game. Because once you remain in the system long enough, the outcome becomes increasingly less about skill and more about persistence. Another major shift happens at this stage. Your relationship with money begins to change. Instead of viewing money as something you constantly earn and spend, you start to see it as something that can grow independently of your effort. Every dollar begins to represent future potential, not just present value. This changes decision-making in subtle but powerful ways. Unnecessary spending feels heavier. Saving feels more meaningful. Investing feels more natural. Because you begin to understand an important truth. Every financial decision is not just about today. It is about the next 20 or 30 years of compounding. And once that mindset is established, it becomes extremely difficult to unlearn. However, even with this understanding, discipline remains the ultimate filter. Two people can know the exact same strategy, understand the same math, and still end up in completely different financial positions. The difference is simple. One stays consistent. The other does not. And over long enough time periods, consistency always wins. Which is why reaching $100 zero is not just a financial milestone, it is a behavioral proof. It proves that you can delay gratification, stick to a system, ignore short-term noise, and trust long-term processes. And once those behaviors are established, the rest of the journey becomes far more predictable. Because at that point, you are no longer trying to figure out how to get rich. You are simply continuing a process that is already working. When people talk about becoming a millionaire, they usually focus on the final number, $1,000,000, as if that is the true goal. But in reality, the most important milestone is not the destination. It is the first major proof that the system works, $100,000. This is where something fundamental changes, not in the market but in you. At the beginning, investing feels uncertain. You are not sure if your habits are strong enough, or if the process will actually lead anywhere meaningful. Every contribution feels like a small, almost invisible step forward. But once you reach $100,000, something shifts. You are no longer guessing whether the system works. You have evidence. You have stayed consistent for years, continued investing despite market ups and downs, avoided giving up during slow periods, and built something that is no longer small or symbolic. Even if the number does not yet feel life-changing, it represents something far more important. You have proven that you can build wealth slowly and consistently. And that proof is more valuable than the money itself at this stage. Because once you can do it once, you can continue doing it. At this point, your financial identity begins to change. You are no longer someone who is trying to invest or hopping to get ahead. You become someone who already understands the system and is actively operating within it. This is also where compounding starts to become more emotionally visible. Before $100,000, growth often feels abstract, but after crossing this threshold, the effects of returns begin to feel more tangible. Annual gains become noticeable, market movements become more meaningful, and fluctuations, while still uncomfortable at times, are now understood in context. You are no longer reacting emotionally to every change. You are observing a system that you understand. And that understanding creates stability. Another important shift happens here. Confidence replaces uncertainty. Instead of asking, "Is this working?" you begin asking, "How can I stay consistent longer?" That is a completely different mindset. Because the focus is no longer on validation, it is on endurance. And endurance is what unlocks everything that comes next. As your balance continues to grow beyond $100,000, compounding becomes more visible, more powerful, and more self-sustaining. The system begins to accelerate in a way that rewards patience disproportionately. But none of that matters if you never reach this first milestone. That is why $100,000 is not just a financial checkpoint. It is a psychological threshold. It separates those who understand the theory of wealth building from those who have actually experienced it in practice. And once you cross it, the path forward is no longer uncertain. It becomes simply a continuation of what has already been proven to work. Once the system is proven to work, and the psychological barrier of $100,000 is crossed, the real determining factor of your financial future becomes surprisingly simple. Consistency over time. Not intelligence, not timing, not even the exact investment choice in most cases, but the ability to repeat the same behavior for long enough that compounding can fully express itself. At first, this idea sounds almost too simple to matter. People often expect wealth building to require complex strategies, constant optimization, or perfect decision-making. But the reality is much more understated. Most of the difference between financial success and financial struggle comes down to whether someone stays in the system long enough without interrupting it. Because compound growth does not reward intensity, it rewards duration. Even modest contributions, when repeated consistently over decades, begin to produce outcomes that feel disproportionate to the effort involved. What starts as a small weekly habit eventually transforms into a significant financial engine. But this only happens under one condition. The system must remain uninterrupted. This is where many people unknowingly sabotage their own progress, not through one big mistake, but through a series of small disruptions. Stopping during market downturns, withdrawing investments too early, abandoning plans due to short-term frustration, or constantly switching strategies. Each interruption resets or slows the compounding process, and when time is the most important variable, interruptions become extremely costly. Meanwhile, those who remain consistent, even if they are not perfect, continue to benefit from the accumulation of time in the market. And over long periods, this creates a widening gap that has little to do with income or opportunity, and much more to do with behavior. Another important realization at this stage is that wealth is not built evenly across time. It is heavily weighted toward the later years. In the early phase, progress feels slow because you are building the base. But in the later phase, that base begins to produce accelerating returns. This is why two people can follow the same strategy, but experience dramatically different results depending on how long they stick with it. The difference between almost there and financially free is not necessarily effort. It is often just time compounded. And this is where patience becomes a financial advantage. Because most people underestimate how powerful long-term consistency really is. They expect visible results too early, and when they don't see them, they assume the system is not working. But in reality, the system is simply not finished yet. Compounding does not operate on human impatience. It operates on mathematical time. And those who understand this early are the ones who eventually benefit the most, not because they did something special, but because they did something ordinary for an extraordinary amount of time. As your portfolio moves beyond the mid-six-figure range, something fundamentally different begins to happen, not just in numbers, but in how your entire financial life operates. At this stage, you are no longer simply building wealth. You are now entering a phase where your wealth begins to actively participate in your life. The most important shift is this: your investment returns start to resemble income. Not small, symbolic amounts, but meaningful, noticeable financial contributions that can influence real-life decisions. Where earlier in the journey, your weekly contributions were the primary driver of growth, now the returns generated by your existing capital begin to take over that role. Each year, your portfolio can grow by amounts that once took you years of saving to achieve. This creates a powerful psychological reversal. You begin to see that your financial system is no longer dependent on constant effort. Instead, it is increasingly driven by accumulated time in the market. And this is where the concept of financial independence starts to feel real, not as a dramatic event, but as a gradual shift in dependence. Because independence is not defined by never working again. It is defined by having options, and options begin to appear when your investments start generating meaningful, recurring growth. At this stage, many people experience a new kind of clarity about money. Spending decisions are no longer viewed only in terms of immediate cost, but also in terms of long-term opportunity cost. A simple purchase is no longer just a purchase. It also represents potential future growth, compounded returns lost over decades, and reduced capital working in the system. This doesn't necessarily lead to extreme frugality. Instead, it leads to intentionality. You become more aware that every financial decision interacts with a long-term system that is now large enough to matter. Another key transformation is psychological security. Even though markets still fluctuate and volatility still exists, your emotional reaction to it begins to soften. Why? Because your baseline has changed. A downturn no longer represents loss of progress, but rather a temporary fluctuation within a much larger upward trajectory. And more importantly, you now understand that volatility is part of the mechanism, not a failure of it. This understanding allows you to stay invested with far less emotional resistance than before. As a result, your consistency improves even further, which in turn strengthens the compounding effect. This creates a reinforcing cycle where consistency leads to growth. Growth leads to confidence. Confidence leads to more consistency. And that loop becomes increasingly self-sustaining over time. Eventually, the system reaches a point where your financial future is no longer defined by uncertainty, but by probability. The longer you stay consistent, the more predictable the outcome becomes. At this stage, wealth is no longer something you are trying to build. It is something that is already in motion, continuing to expand in the background, regardless of daily attention. And your role shifts from builder to maintainer of the system. At this stage of the journey, the math is no longer the hardest part to understand. In fact, most people can follow the logic of compounding, long-term investing, and steady contributions without much difficulty. The real challenge has shifted elsewhere. It is now entirely psychological. Because building wealth over decades requires you to operate in a way that directly conflicts with how most of modern life is designed. Everything around you encourages speed, immediacy, and constant feedback. Results now. Rewards now. Validation now. But compounding operates on an entirely different timeline. It is slow, silent, and often invisible in the early stages. And this mismatch creates friction. Many people start their journey with motivation, but motivation is not designed to survive long periods of low visible progress. When account balances grow slowly, or when markets remain flat for months or years, doubt naturally begins to appear. This is where most failures happen. Not during the exciting moments, but during the quiet ones. People begin to ask, is this really working? Am I wasting time? Should I try something else? And slowly, consistency breaks. But the interesting part is that nothing about the system itself has changed. The math is still working exactly as intended. The only thing that has changed is the individual's perception of time. This is why wealth building is often less about strategy and more about emotional endurance. Those who succeed are not necessarily the ones who make the best decisions at every moment. They are the ones who simply remain in the system long enough for compounding to express its full effect. Another important psychological shift occurs here: identity. At the beginning, most people see themselves as someone who is trying to invest or trying to save. But over time, those who stay consistent begin to see themselves differently. They are no longer experimenting. They are participating in a long-term system that is already working. This identity shift is subtle but powerful, because once someone sees themselves as an investor rather than a participant, their behavior naturally becomes more stable. They are less likely to panic during downturns, abandon strategies impulsively, or compare themselves constantly to others. Instead, they focus on continuity. And continuity is what compounds. It is also at this stage that people begin to realize a deeper truth about wealth building. The hardest part is not earning money. It is resisting the urge to interrupt time. Because every interruption, every withdrawal, every panic decision, every premature exit breaks the compounding curve. And over long periods, broken consistency is far more damaging than imperfect returns. Meanwhile, those who stay consistent through all phases, especially the boring ones, continue to accumulate time inside the system. And time, when combined with capital and returns, is the true engine of wealth. Eventually, what once felt slow becomes obviously powerful in hindsight. But at the moment it is happening, it often feels like nothing special at all. And that is exactly why so many people underestimate it. At some point in the long journey of investing and compounding, a final realization begins to emerge. It doesn't arrive suddenly. Instead, it develops gradually as years pass and patterns become undeniable. That realization is this: wealth is not fundamentally a money system, it is a time system. Most people begin their financial journey thinking in terms of income, how much they earn, how much they can save, and how quickly they can increase those numbers. But over time, this perspective becomes less important. Because what truly determines the outcome is not the size of each contribution, but the amount of uninterrupted time those contributions remain in the market. Once this is understood deeply, the entire framework of financial thinking changes. A person is no longer focused on maximizing short-term gains or searching for the perfect strategy. Instead, they begin to optimize for something far more powerful: longevity in the system. This is where the earlier milestones, $10, $000, $50,000, $100,000, take on a new meaning. They are no longer just financial achievements. They are evidence of survival in a system that rewards patience more than intensity. And as the portfolio continues to grow, another truth becomes increasingly visible. The majority of wealth is not created evenly over time. Instead, it is heavily concentrated in the later stages of the journey, when compounding has had enough time to accelerate. The early years build the foundation, but the later years produce the exponential expansion that defines true financial transformation. This is why two individuals with similar incomes can end up in dramatically different financial positions. The difference is not always what they did. It is often how long they allowed compounding to work uninterrupted. At this point, the emotional relationship with money also becomes more stable. Market fluctuations no longer carry the same weight they once did. A downturn is no longer interpreted as failure, but as a temporary phase within a larger, ongoing process. This perspective creates resilience, and resilience allows consistency to continue, and consistency over time becomes wealth. Eventually, something subtle but profound happens. Money stops feeling like something you are actively managing every day. Instead, it becomes something that evolves in the background of your life, shaped primarily by decisions made years ago. You are still involved, but no longer constantly reactive. And this shift marks the final stage of understanding. You are no longer building wealth moment by moment. You are allowing a system you already built to mature over time. At that point, the question is no longer, how do I get rich? It becomes, have I stayed in long enough for time to do its work? And for those who answer yes, for long enough, the outcome is no longer uncertain. It becomes mathematically inevitable.